You're listening to this article from Convertz.app. De-Dollarization in 2026. How BRICS, the Yuan, and a shifting world order are reshaping global currency. What is de-dollarization? De-dollarization is the process by which countries reduce their reliance on the US dollar for international trade, foreign exchange reserves, and financial transactions. It doesn't mean the dollar disappears. It means the dollar's share of global economic activity shrinks as alternatives emerge. For decades, the US dollar has been the undisputed king of global finance. Oil is priced in dollars. International loans are denominated in dollars. Central banks hold the majority of their reserves in dollars. When two countries that don't use dollars trade with each other, they often convert to dollars as an intermediary anyway. But in 2026, that dominance is being challenged more seriously than at any point since the dollar replaced the British pound as the world's primary reserve currency after World War II. The dollar's declining share, by the numbers. The data tells a clear story of gradual but accelerating erosion. Foreign exchange reserves. 2000. The dollar made up approximately 71% of global central bank foreign exchange reserves. 2015. That share had fallen to about 65%. 2020, down to roughly 59%. 2024, approximately 57%. 2025 to 2026, estimates range from 54 to 57%, with the IMF's COFR data showing the lowest dollar share since records began in 1995. That's a decline of roughly 15 to 17 percentage points in 25 years, a massive shift when you consider that global reserves total over $12 trillion. Even a 1% shift represents $120 billion moving out of dollar assets. Trade invoicing. Historically, the dollar has been used to invoice roughly 40 to 50% of all global trade, far exceeding the US's approximately 10% share of global trade by volume. This is declining. Russia-China trade. Over 90% is now settled in yuan and rubles, up from less than 30% before 2022. China-Brazil trade. The yuan has replaced the dollar as the primary settlement currency. India-Russia energy trade, largely conducted in rupees and dirhams, UAE, bypassing the dollar. ASEAN nations are actively developing local currency settlement frameworks to reduce dollar dependency. SWIFT versus alternatives. The SWIFT messaging system, which facilitates most international bank transfers, has long been dollar-dominated. But alternatives are gaining traction. China's CIPS, cross-border interbank payment system, processes over $10 trillion annually and connects more than 1,400 financial institutions across 110-plus countries. Russia's SBFS handles domestic interbank messaging after Russia was partially cut off from SWIFT in 2022. India's UPI has been internationalized, with Singapore, UAE, and other nations connecting to India's payment infrastructure. mBridge, a multi-central bank digital currency platform connecting China, Thailand, Hong Kong, UAE, and Saudi Arabia, designed explicitly to enable dollar-free cross-border payments. Why is this happening now? Number 1. Weaponization of the dollar. The single biggest catalyst for de-dollarization has been the US's use of financial sanctions as a foreign policy tool, specifically, the decision to freeze approximately $300 billion in Russian central bank reserves after the 2022 invasion of Ukraine. This sent a shock wave through central banks worldwide. The lesson was clear. If you hold reserves in dollars, the US government can freeze them at will. Even countries that are currently allied with the US began asking, could this happen to us? The freezing of Russian reserves crossed a line that had been considered sacrosanct in international finance, the safety of sovereign reserves held in another country's currency. Once that precedent was set, diversification away from the dollar became not just an economic preference, but a national security priority for many countries. Number 2. The rise of China. China's economy has grown to rival the US in purchasing power parity terms, and Beijing has been systematically building the infrastructure to internationalize the yuan. The Belt and Road Initiative created a network of yuan-denominated loans and trade relationships across 140-plus countries. China became the world's largest trading partner for more countries than the U.S., giving it leverage to demand yuan settlement. The People's Bank of China has established bilateral currency swap agreements worth over $500 billion with dozens of central banks. Yuan-denominated oil contracts on the Shanghai International Energy Exchange have captured a small but growing share of global oil trading. The yuan's share of global payments has risen from about 1.5% in 2020 to roughly 4 to 5% in 2026. That's still small compared to the dollar's approximately 40% plus, but the trajectory matters. Number 3. BRICS expansion. BRICS, originally Brazil, Russia, India, China, and South Africa, has expanded dramatically and now represents a bloc with serious economic weight. Current BRICS Plus members, as of 2026, Brazil, Russia, India, China, South Africa, Original 5, Saudi Arabia, UAE, Egypt, Ethiopia, Iran, joined 2024. Indonesia, Turkey, and several others have joined or are in accession talks. Combined BRICS Plus statistics. Approximately 45% of the world's population. Approximately 36 to 40% of global GDP, PPP terms. Approximately 44% of global oil production, with Saudi Arabia and UAE. Approximately 25% of global goods exports. The bloc has announced plans for a BRICS cross-border payment system that would allow member nations to trade in local currencies without converting to dollars. While implementation details remain fluid, the intent is clear. Create a parallel financial infrastructure that doesn't route through New York or depend on U.S. goodwill. Number 4. U.S. fiscal concerns. The U.S. national debt has surpassed $36 trillion and continues growing. Annual interest payments on the debt now exceed $1 trillion, more than the entire defense budget. This has raised questions about the long-term sustainability of U.S. fiscal policy and, by extension, the dollar's value. Central banks notice these dynamics. If the U.S. is running persistent deficits and accumulating debt at an accelerating rate, holding dollar reserves means holding an asset whose issuing government may have to inflate away its debts eventually. Diversification is a rational response. Number 5. Tariff uncertainty. The 2025 to 2026 tariff regime has added another reason for countries to reduce dollar dependency. If the U.S. is willing to use trade policy aggressively against allies and partners alike, those partners have an incentive to insulate themselves from dollar-based economic coercion. De-dollarization and tariff retaliation are part of the same playbook. What are countries moving into instead? Gold, the oldest reserve asset. Central bank gold purchases have surged to historic levels. Global central banks purchased over 1,000 tons of gold in 2024, near record levels. China's central bank, PBOC, has been the most aggressive buyer, adding hundreds of tons to its reserves over the past 3 years. Poland, India, Turkey, and Czech Republic have also been major buyers. Gold's share of global reserves has risen to its highest level in decades. The logic is simple. Gold has no counterparty risk. No government can freeze your gold if it's held in your own vaults. Track live gold prices with our metals converter, the Chinese yuan. As mentioned, the yuan's share of global trade and reserves is growing, but from a low base. Barriers to yuan dominance include capital controls. China maintains strict controls on capital flows, making the yuan less freely convertible than the dollar or euro. Transparency concerns. Foreign investors worry about the opacity of Chinese economic data and the PBOC's willingness to intervene in currency markets. Financial market depth. U.S. Treasury markets are the deepest and most liquid in the world. China's bond markets, while growing, don't yet offer comparable depth. The yuan is unlikely to replace the dollar outright. Instead, it's becoming one of several alternatives in a more multipolar currency system. The euro. The euro is the second most held reserve currency at roughly 20% of global reserves. It could benefit from de-dollarization, but Europe has its own challenges. Fragmented fiscal policy. Each Eurozone nation issues its own bonds. slower economic growth than the U.S., energy dependency and geopolitical risk from proximity to Russia, digital currencies and CBDCs. Central bank digital currencies, CBDCs, could eventually play a role in de-dollarization. Over 130 countries are exploring or piloting CBDCs. The digital yuan, Chinese yuan, is the most advanced major economy CBDC, already in widespread domestic use. The mBridge project demonstrates how CBDCs could enable cross-border payments without the dollar. However, CBDC development for international use is still in early stages and faces significant technical, regulatory, and geopolitical hurdles. Cryptocurrency. Bitcoin and other cryptocurrencies exist outside the traditional currency system entirely. While they're too volatile and limited in throughput for large-scale international trade settlement, they offer no counterparty risk, similar to gold. Censorship resistance. No government can freeze Bitcoin transactions. 24 out of 7 global availability. El Salvador and the Central African Republic have made Bitcoin legal tender. Other nations have explored crypto as a sanctions evasion tool. The role of crypto in de-dollarization remains small, but philosophically significant. Monitor crypto prices with our converter. What this means for exchange rates. Short to medium term, 2026 to 2028. Dollar weakness. The structural decline in dollar demand is likely to continue, putting gradual downward pressure on the dollar's value against a basket of currencies. This doesn't mean a crash. The decline is measured in percentages per year, not dramatic collapses. Yuan strengthening. As more trade is invoiced in yuan, demand for the currency increases. But China also has incentives to keep the yuan from appreciating too fast. It would hurt exports. So PBOC intervention may limit gains. Gold appreciation. With central banks buying aggressively and fiat currency confidence eroding, gold is likely to remain well supported. Check current gold prices. Emerging market currencies. Countries that successfully reduce dollar dependency may see their currencies stabilize or strengthen, particularly if they develop deeper local capital markets. Increased volatility. The transition from a unipolar to multipolar currency system inherently creates more volatility. Exchange rates that were previously anchored by universal dollar usage become more dynamic. Long-term, 2030 plus. Most economists don't predict the dollar losing its reserve currency status entirely. Instead, the consensus is a shift toward a multipolar currency system where the dollar remains the largest single reserve currency, but with a share closer to 40 to 45%, down from today's 54 to 57%. The yuan, euro, and possibly a BRICS-linked unit or basket each hold 10 to 20% shares. Gold plays a larger role as a neutral reserve asset. Digital currencies and new payment systems reduce the dollar's role as a transaction currency even faster than its decline as a reserve asset. How this affects you. If you hold US dollars, a gradually weakening dollar means your purchasing power for foreign goods and services will erode over time. This affects international travel. Your dollars buy fewer euros, pounds, yen, or other currencies each year. Monitor exchange rates before traveling. Check rates here. Imported goods. As the dollar weakens, imports get more expensive, compounding the tariff effect discussed in our tariff impact article. Foreign investments. If you hold international stocks or bonds, a weaker dollar actually helps. Your foreign returns are worth more when converted back to dollars. If you earn in other currencies, euro, pound, yen holders, your currencies may appreciate against the dollar over time, increasing your purchasing power for American goods, services, and travel. Emerging market currencies. More volatile but potentially appreciating if your country successfully diversifies trade away from the dollar. Yuan holders. The yuan's trajectory depends heavily on Chinese government policy, which prioritizes stability over appreciation. For international business, invoicing currency matters more than ever. Businesses that lock into dollar-only invoicing may be leaving money on the table or exposing themselves to unnecessary currency risk. Multi-currency accounts, increasingly valuable for businesses operating across borders. Holding balances in multiple currencies reduces conversion costs and hedging needs. Payment system diversification. Businesses dependent on SWIFT-based dollar payments should explore alternatives to reduce concentration risk. For investors, diversify currency exposure. Don't hold 100% of your assets in any single currency. Geographic and currency diversification is increasingly important. Gold as a hedge. Central banks are telling you something by buying gold at record rates. Consider whether your portfolio has adequate exposure to hard assets. Track gold prices. Watch the data. Follow the IMF's COFR reports quarterly, central bank gold purchases monthly from the World Gold Council, and SWIFT's RMB tracker monthly for real-time signals on de-dollarization's pace. Crypto as insurance. A small allocation to Bitcoin or other major cryptocurrencies can serve as a hedge against the systemic risks of fiat currency regime change. Check crypto prices. Is this the end of dollar dominance? No, at least not anytime soon. The dollar still has massive structural advantages. Network effects. Everyone uses dollars because everyone else uses dollars. This is enormously difficult to disrupt. U.S. military power. The dollar is backed by the world's largest military, which provides security guarantees to allies and ensures freedom of navigation for global trade. Financial market depth. U.S. Treasury and equity markets are the deepest, most liquid, and most transparent in the world. No alternative comes close. Rule of law. For all its flaws, the U.S. legal system provides stronger property rights protection than most alternatives, particularly China. Innovation economy. The U.S. remains the world's leading destination for venture capital and technology investment, generating demand for dollars. What we're witnessing is not the death of the dollar, but the birth of a more multipolar financial system. The dollar will remain the world's most important currency for decades, but it will share the stage with others to a degree not seen since the mid-20th century. For anyone who trades currencies, invests internationally, or simply buys imported goods, understanding this shift isn't academic, it's practical. The exchange rates you see today are shaped by these forces, and they'll continue to evolve. Stay informed, diversify wisely, and use tools like our currency converter to keep track of how these global shifts affect your specific situation. Disclaimer: this article is for informational and educational purposes only and does not constitute financial, investment, or policy advice. Data cited is based on published reports from the International Monetary Fund, IMF, World Gold Council, Bank for International Settlements, BS, People's Bank of China, SWIFT, and major financial news outlets as of February 2026. Currency markets and geopolitical dynamics are subject to rapid change. Always do your own research and consult qualified professionals for advice specific to your situation. That's the end of this article. Visit Convertz.app for more guides and free conversion tools.